you would never see an institutional investor investing only in German stocks. They always have a global approach. They have US stocks, they might have German stocks, they might have UK stocks, they might have some Asian stocks. So it's like natural thing to be globally diversified. But when it comes to venture, people think they have to only invest in their own cities sometimes even. You're living in Hannover, you think startups in Hannover are the best startups in the world. It's just stupid, in my opinion.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Ertan Can with us. Ertan is the founder of Multiple Capital, a fund of funds investing in VC funds across the world. So in this episode, we'll be talking about what is a fund of funds, how it operates, how they evaluate VC funds, how many of them they back in a year, LP reporting, diversification, his advice for emerging managers looking to raise their first fund, and a lot more. So without wasting any time, let's dive straight in. Hey Ertan, so good to have you on the VC10X podcast. How are you doing?
I'm very good. Thank you for having me.
Yeah, pleasure hosting you. So to start things off, can we have your story and how you became an LP because you run a fund of funds, right?
Yes. So my story is like that. I've started to work for a family office in Germany, and I was hired to do early stage direct investments. So I was hired to invest into early stage companies. And I realized very soon that I'm not the right guy to do early stage investments. I didn't have really a tech background and not really an investment background in early stage tech. And I realized that I'll lose most of the relevant deals that I saw to top branded VC funds and top branded angels. So I went back to the family office and told them, look, I don't think that this is the right strategy to do. And I proposed to do something completely different. And at that time, 10 years ago, something that almost no one really did, which was, building a pan-European VC portfolio in terms of, investing into VC funds as an LP instead of into companies. So instead of having 10, 15 companies in the portfolio, all of a sudden we had like 10 funds in the portfolio and 300 to 400 companies in the portfolio, ultra diversified across Europe. And it was very successful compared to the direct investment part. And that's the story how I started to invest into funds and how I became an LP.
That's very interesting. And I would like to understand more about contrasting the two, basically. The investing directly into startups, that is the VC fund model, and also the fund of fund model that you are doing right now. So I want to contrast what do the return profiles look like? What are the return expectations? And is it easier to manage a fund of funds? Do you need to have a bigger assets under management to be able to run a fund of funds? Or is that just a misconception? So can you throw some light on that? Because I believe when you were pitching to the family office at the time that, okay, let's do this thing, I think you would have produced these facts that, okay, contrasting these two and why this might be a good approach as well, right?
Yes. So starting with your last question, I think yes, the assets under management have to be slightly larger, or let's say double the assets, because the fees are lower, right? So typically we have half the fees of a normal fund. Means if a normal fund has 2%, we have 1% management fees. Or if a normal fund has 20% carry, we have 10% carry. So to get the same kind of fee generating out of the fund, you have to have double the fund size. And there are other reasons why the fund size and fund of funds or assets under management of fund of funds can help or make sense. In our personal opinion, with our thesis, we still think we can be very small as a fund of fund. But yeah, you have to scale at some point to a minimum level. Let's say like this. To the fee layers, it's very interesting discussion, because I think very often it's very much misunderstood by a lot of LPs. Yes, there is a second fee layer for fund of funds, but this is always a make or buy decision, right? And we think that family offices that invest less than 20 million into that specific asset class through fund of funds or fund investments, in my opinion, it's very difficult to beat the costs that were related to invest in a fund of funds. So again, the running costs investing in a fund of fund is around 1%. So if you would invest like 5 million into a fund of fund, that would equal to roughly 50K costs a year. And we think that it's not possible to deliver the same kind of quality and selection that we do with 50K costs at the family office level. So it will be just a misperception at a family office that they can do that for a 5 million check. So we think, again, up to 20 million, because that's roughly the cost that you would need, 20K, to run something similar that we do at a family office in-house, right? So, but if someone is investing 50 or 100 million, yes, it's theoretically cost-wise probably smarter to do that in-house, or it's possible. But then on the other hand, especially fund of funds are used by larger vehicles, larger institutional vehicles, who could easily do it internally cheaper for that amount that they are going to invest. And now we are talking about the second part, which is quality. One part is quantity. Yes, quantitatively you can, again, after 20, 25 million, it's probably possible to do it in-house as a family office. We think qualitatively it's a different discussion because you need the right people, right? So you need a team that is incentivized, and has the right alignment with you to do this right job. And most of the time, those people are like we are doing their own business and not working for a family office. So it's a difficult discussion, but especially in reality, the larger the institutions, the easier for them to allocate through a fund of fund into an asset class like venture. But then our focus is at the moment the smaller end, so investors up to 10 million, where we think it's almost impossible up to 10 million to build something that we are building, and that's our focus. And for that, the fees are even lower than trying to do it yourself. If you want to build this kind of diversified broad portfolio and want to screen the whole market and want to understand where to deploy the money.
Right, absolutely. And I believe even fund of funds must be having their own investment thesis. So if you have one at multiple capital, then what does that investment thesis look like?
Our thesis is it hasn't changed for the last 10 years. So I started 10 years ago when I was still with the family office to look and invest only in what we call micro-VCs, so small VC funds. And so today it's still the same thesis. For after 10 years, we look for micro-VCs that invest very early stage. And what does that mean? In numbers, we invest in funds up to roughly 50 million in fund size. The average is between 20 and 30 million in fund size, and we expect those funds to deploy most of the capital pre-Series A, which is for us something like a signal. So as soon as you achieve Series A, it's not really it's a very competitive game for the right companies. But before the Series A, it's still accessible. So if you are the right team in the right region or in the right vertical, you have a better access to the right companies, and that's the way how we built our portfolio, and that's the thesis that we have for 10 years now.
Right, got it. And like you just said that you have a thesis around investing in micro funds, micro VCs, and I also saw on your website that you're mostly investing in solo GPs, right? So why that thesis? What's the reasoning behind that?
We're not mostly investing into solo GPs. We're just not excluding solo GPs. So we can always invest into a solo GP. So for us, it's not, is it a solo GP or not? For us, it is it a small enough fund, and do they invest very early stage? And it can be a solo GP. So what it means in result, I think 1/3 of our portfolio are solo GPs. It's just a natural thing that solo GPs are small and very focused and invest very early stage. So that's the reason. But if a solo GP would run, there is a very famous solo GP, Oren Zev. If Oren is running, I think, hundreds of millions of fund sizes, we would never invest in Oren's fund.
Got it, understood. And while these solo GPs or GPs are coming to pitch their funds to you, on what basis are you evaluating their funds while deciding whether to invest or not?
It's the same as for not solo GPs for us. So again, it would be like looking at the fund size, looking at the thesis of the funds, looking at the background of the GP. So it doesn't matter for us if it's one GP or three GPs. The process would be more or less the same.
Yeah, exactly. I wanted across the board. So basically, what are the key things that you're looking for? Is it like the track record? What are the past experience and things like that? Or do you also want an investment track record as well? That what are your previous investments like? What's
So
the
the
return
investment
on
track
that?
record helps, but it's not necessary for us.
Okay.
Okay. But the ideal case for us is, let's say, two GPs who in the past maybe have founded a company together, exited that company, earned some money with that exit, started investing as angels for a few years together, build a portfolio of 50 angel investments, have some track with the angel investments, but at the same time, one of them is maybe has also a technical background. So that's the ideal world. And then start raising a small fund. Now we're talking about ideals, and then something between reality and ideal, right? So that's but again, for us, again, the hard facts are very clear. We invest only in small funds. We invest only in funds that invest pre-series A. We don't invest in broad generalist funds. So most of the time we expect something where you are specialized on. That could be a region, or it could be a thematic focus. Again, track is helpful, but it's not necessary. Yeah, and the rest is, it's rather subjective. Do we like the GPs? Do we trust the GPs? Do we have good reference calls? Do other GPs in our portfolio like them or not? Do they have like, who are the co-investors? Who are the follow-on investors? Other people that people like to work with, and that decreases the number of the universe, so we can select them. But sometimes it's just very difficult. Sometimes you have 2-3 funds in the same region doing very similar stuff, and we like all of them, but we can only invest in one of them.
Right, absolutely. And it is always said that if you want to raise a fund, or if you're raising your first fund as a first time GP, then it's incredibly hard to like reach out to LPs and then pitch them. And like LPs are not very visible all the time, like unlike you. Uh, a lot of these LPs are not don't have their emails in the open, so you have to really go and look for them, email them. You're not really sure are they seeing your emails or not.
Right.
So I want to understand for the GPs that are pitching you, how much time does it take for you to are you replying to all the emails, all the pitches that you get, or are you being selective in that? And then how much time does it take to actually for an LP to show interest that okay, this seems interesting, we can talk, and then actually then wiring the money? So how much time does it take typically?
It depends. It depends on various factors. It depends on if we are actively deploying capital, because we are not always actively deploying when the funds are not ready. In between funds, we have sometimes no deployments. It depends how much we have done in that year already. So if you're starting to deploy, or if you are fully deployed already, and reaching out to us and replying, it's always a challenge for us. We're a very lean, small team. We try to reply to all of them, but if we see it's clearly out of our scope, sometimes we just don't reply, because it's easy to understand what we do. So we're not doing private equity. We're not doing a 300 million fund. We're not doing, this kind of things we're not doing. And if still someone, let's say an investor relations person from that fund, reaches out to us, or even a placement agent, we probably don't reply. But if it's a fund that is within our scope, we typically reply, and we have, again, the best way for us to reply or cover the deal flow is, we have a contact us button on our website, and which leads to an Airtable in the end, and where you can share some of the information that we need. And it's the easiest way to share it, because all the team of us have access to it, and it's much quicker for us to say yes or no. And typically, if we say no, then we can say easily, and within a few weeks, no. Most of the time, we have like a backlog of, let's say, 4 to 6 weeks, so until we have really screened all funds. And at the moment, it's just the case that there is an explosion of new funds. So it's not like 10 years ago, we looked at maybe 10 funds per month. Now we're looking at 100 funds per month, and it's a difference, and it's a different scale. And and as soon as we like a fund, we let them know, and we start the process. And what does that mean? Start the process. In our case, most of the time it takes a few months even until we commit. Um, Again, different things. We try, if we don't know, I've never heard of the GP, we try to build a relationship with the GP. If the GP is in another geographical region, it's more difficult to build that relationship. So we try to keep an ongoing conversation. That might be once a month a call, or we ask them to send us regular updates. And if they do that, we see like how diligent they are. We see the process in their fund, what's happening. Sometimes the first investments. again, for us, it's not. Some of the GPs come back and tell us, hey, we have this and that LP, and now are you coming in? For us, it's not relevant. So we don't care about your other LPs, to be honest. It's not a sign or a signal for us if other LPs are in that. It's not like in venture where, I don't know, if Sequoia is going to invest, you want to invest as well. We don't consider ourselves a following co-investor. We are considering ourselves, if we are completely convinced that the fund is the right bet for us, we would do it even without any famous or known co-investor, co-LP. So for us, it's really, are you delivering what you promised, more or less? Are you investing into the kind of deals that you think you wanted to in the region or in your within your focus? Can you show us, co-investors that like you and that we like? This is the kind of relationship that we build if we don't know the person earlier, right? So sometimes we know the persons already. So for example, if there is a spin-off, if they are spinning off from a larger fund, we know sometimes the managers. And so then it's easier for us to commit because we know them already. We know their brand as an individual. And then it can be within 2 months, that we commit and wire the money if we commit. And the longest case, it can take up to a year, and from the first, I think in some cases it took 2 years because we met the team, they wanted to raise a fund, and then it took them 1.5 years to even have their fund ready to raise, and then they do their first close after 2 years, and we were like committing into their first close after 2 years. We've met them in the first time. So this is really like the scope is between, I would say, 6 weeks to up to 2 years sometimes. Currently, funds are raising quicker. But if you look back 2-3 years, some of the best funds in our portfolio, they needed 4 years to raise their first fund. One famous example is, he's considered a superstar now in Europe, but he needed 4 years to raise his first fund. And that has changed now. Maybe it's changed again this year. I don't know, but that's the kind of length of time that we need sometimes to meet someone from the first meeting until we commit to it.
Right. Yeah, that's incredibly insightful and something to learn for all the VCs out there. What's the expected time frame? And one more thing I would like to learn, like, is there a way for a GP to know that is a fund currently deploying or not deploying? Because in a lot of the cases, you're not deploying at that time, but they can still, your form is open, they can still write in, right? So is there a way to figure out if an LP, maybe you or someone else, they're actually deploying or not?
And the best way is to ask, of course.
Right.
And we are quite open about if we have a fund at the moment or not. If someone
Right.
asks about it, we don't want to promise anything that we can't hold. And that's one way, I would say, to get that information. As you know or might not know, in Europe, you're not allowed to talk about your next fund publicly if you don't have a next fund. So it's always difficult to do that publicly. But in many cases, for example, if people don't ask us, and we see that this fund probably will take 6 to 12 months until it's ready, or they have done, the first or the final close, we're not like, it's fine for us. We keep them in our deal flow, we keep them as a lead, and as soon as we're ready, we would reach out and then start the process. And sometimes we start the process even earlier when we think, okay, this is a fund that we really like, and we want to be ready as soon as we are ready, right? So we do some pre-work. If we are convinced that this fund is a great fund, the GP is the right one that we want to back, and the timeline could be within our next fund, we start doing the work earlier. Sometimes we miss, right? Sometimes we need longer, and we have not closed, and we miss those funds. And but that's it really depends. But sometimes we just do the work before. Again, really it depends. But we're quite open about it. We don't like. There are other LPs who claim to have hundreds of millions, and we know by fact that they don't have that. So we are not claiming anything like that. We are quite open about the funds to ask, and we tell them where we are at the moment and what our plans are. So typically what our plans are is to do up to 10 investments or around 10 investments per year, 10 fund investments per year. And we try to hold that every year. At the moment, for example, we don't have an active fund. but we hope to be back in 2023 with an active fund, and then we will do the 10 investments in 2023 and continue to do the 10 investments in every year from now on. And we've done that more or less in the last 5 years, 4 years.
Yeah, got it. And like talking about the return expectations, I know for VCs, the return expectations are in multiple X's, and most of the startups fail, but the ones who succeed, they want them to like really win big to be able to like balance out the others and then also turn a profit on the overall fund size. Talking about your model, the fund of funds, right? So, what are your expectations from the VC that you've invested in? What kind of return should they be giving? What's the typical expectation there?
Yes. So our case, our focus on micro VCs leads to outlier returns within the funds sometimes, right? So if one of the funds that we invest in is in the right company or is in several right companies, this has a huge effect on that fund in terms of returns because the fund is very small and invests very early on. So what does it mean in numbers? I think the best funds in our portfolio can return 10x or more, okay? And that happened in the past already. We are, again, we are invested in 45 funds so far, and we have seen that happening in the past. But at the same time, not every fund will return this kind of numbers. Not every fund will be an outlier. Like, imagine you're a VC fund, you invest in 20 companies or 30 companies. So some of those companies you think will be an outlier, right? But most of the time, I would say not all of the companies will be an outlier. So you will have, some companies not performing well, some companies even not surviving, and a few companies performing extremely well in the ideal case. And this is very similar to our portfolio. So what we do is we select funds that have the opportunity to perform extremely well if they have the right companies in their portfolio. But that does not mean that all of the funds have the right companies in their portfolio. What it means is, even in our case, some funds will extremely outperform. The majority of the funds will be an average return, and some funds will underperform. As soon as we have the outperforming funds, we as a fund of fund become an outperforming fund of fund, or let's say outperforming compared to the VC industry, right? And our target is always relative. So what we always say is that we want to achieve top quartile venture returns. So the top 25% of venture funds, what they return as a fund of fund, or even more important for me personally, top decile fund of fund returns. So being within the top 10% of fund of funds globally. So far in the past 10 years, we achieved the target. And we achieved it almost vintage by vintage, so it means every year. And that's by design, I think, by design of our fund, that's the target that we have to achieve that, being either amongst the 10% best fund of funds globally, or delivering the returns of the best 25% VC funds globally.
Yeah, that's incredible and commendable that you've achieved that target already, and you're doing that year on year. So great job there. And one more thing I want to learn about is like once you have invested in these funds, then how's the tracking happening? That LP reporting that happens, right? How often do you receive those LP reports, and what all contents do you like to see in those reports?
Yes, very good points. So usually we get a quarterly update from the funds, and unfortunately for micro VCs or emerging managers, the quality of the reporting is the range is very, wide. So we have some top quality reportings from some managers, and we have really bad reportings, unfortunately, from some managers who have never done it and are not really good in doing it. So we try to communicate early on with the managers on what we expect or what we like to have, and ideally also what they should prepare in terms of reporting for all the other LPs. Even those other LPs, some of the LPs are first-time LPs, so they don't even know exactly what they should ask for. And so what we ask for, or what is the most important thing, is to have some quantitative KPIs, right? So what have you invested in? What is the fund size? In most reportings, unfortunately, not even the correct fund size is mentioned. So what's the fund size, the committed capital? What have you invested in? And then what is the markup in those investments? So what's what we call total value, to paid in to TVPI. If you can, also on IRR, gross and net. If you have DPI, show us DPI. DPI means distributed to paid in, so what you have distributed. These are the most important KPIs. Not complicated. I think every fund manager should track those fund KPIs from the beginning, and it's also good for yourself to understand where you are compared to other funds. So that's one thing, and then the other thing is like a qualitative reporting. What's happened in your portfolio, any new investors coming in that you like. We like signals that show that the portfolio is going good, it's going well. So we're not super detailed on the expectation on our investments. We are again an ultra diversified portfolio or fund manager, so we're not looking for in-depth details about each company. It's not of interest to us, to be honest. We want to have a general overview that is good enough for us to understand where the portfolio is and to aggregate to our LPs, right? So we want to know what the value of your portfolio is so that we can aggregate those values and define the value in our own portfolio for our investors. Now, having said this, we have the feeling that the reporting requirements and the compliance requirements increase every year, especially in Europe. So means that most of the emerging managers, even emerging managers, should plan with higher reporting standards and even with audits, for example, audited reports once a year. That's a new thing that comes to us in our next fund. So we will expect probably most funds to be audited from next year on when we invest in. And this is can be a challenge in some jurisdictions. In others, it will be, it's just becoming more and more standard, I have the feeling.
Right, absolutely. And recently, even like some funds, some really reputed funds have invested in some of the companies that have gone away like in a day. And now there is a push for like even better diligence to be conducted and standardizing the process of diligence that's conducted, that these things need to be there when you're looking into a company whether to invest or not. So that's definitely getting a lot more attention now. And one more thing that you mentioned in your answer was that you're a really diversified portfolio, right? So when you think about diversification, are you thinking about diversification in terms of regions, that you're diversified across different regions? Someone, a fund investing in the US, and someone, a fund investing in India, maybe, or one in Africa? Or are you thinking about it sector wise, that, okay, there's an ed tech fund, there's a fintech fund, femtech fund, maybe climate tech fund? So how do you think about diversification overall?
Yeah, good question. So diversification has several layers for us. To your question, we do both. So we diversify across regions and we diversify across verticals. So we have, regional funds investing, for example, only in Eastern Europe or the Baltics or Northern Europe. But we have also funds that invest, for example, only in blockchain across Europe, or only in life science across Europe. So both of that is part of our diversification. But on top of that, we think diversification is also important by vintages. So it means that we should not invest everything in one year, but we spread it over years for our fund. We invest in 3 vintages, means, funds from, let's say, 2022 to 2024, 3 vintages, and those funds invest also over several vintages. That means the companies that we invest in are not only in different regions and different verticals, but they are also spread out over 5 to 6 years. That is the kind of diversification that we offer in one fund. And on top of that, of course, we've talked about regions, and we've talked about verticals, and we've talked about vintages, time. But what we think is very important is we diversify across individuals, right? So we have, in each fund, we have something like 60 to 70 GPs. And it means we have 60, 70 different profiles investing into companies. And if you look at, like, we always claim to have around 1,000 companies per fund. If you have 70 GPs for 1,000 companies, it's on average 10 to 15 or 15 companies per GP, right? It's not a diverse, like it's not a lot of people call our model a spray and pray model. But if you look at that, the average GP is investing into 15 companies. It's a very, very concentrated portfolio by GP, per GP. And that's also a high diversification. I think the profiles, the individuals are very, very different when we look into our portfolio. We never wanted to invest diversified in terms of, background of the individuals that we back. So it was always, having a fund in Finland, a fund in Eastern Europe, a fund in Southern Europe, etc. But we never looked at the diversified individuals. But in the end, we realized we've backed solo female GPs. We've backed, a lot of what we consider underrepresented, undernetworked GPs. We've done Black female. Yeah, I'm not even talking about it usually, but we have done, Black female GPs. We have Black female GPs. We never looked at it. Okay, should we invest because they're Black female or not? We just thought, okay, they're great, right? So, and this is the kind of portfolio that I think I'm relatively proud about it, because again, we've never thought about it. We still have a relatively diversified, compared to the market, a relatively diversified portfolio of individuals doing very different things. And I think one of the things that we try to implement more and more in the future is we look at diversity of thought. So if you look at new managers, are they really diverse enough, not only by their background, by their education, by their nationality or ethnics? That's not as important, because it happens. We're not excluding anyone. But do they have enough diversity of thought? Are they thinking differently enough to make it to make a difference in their market? And that's something that we value more than other things. But that's the kind of so long answer to your question, but that's the answer to the diversification. We think, again, venture, as well as like any other asset class, if you are doing it from a passive perception, like if you're a passive investor, like a family office, for example, or an institutional, you're typically not an active investor. You should be a passive investor. And if you are a passive investor, it does not make sense to invest only into a German VC, because they will mostly only cover German companies or a specific kind of companies. It's not enough. We think you should be even a global, you should have a global allocation, right? So maybe not even one fund of fund, but 3 or 4 fund of funds covering globally, the asset class of venture, if you really want to make it professional. The same thing for private equity, same thing for hedge funds, same thing for real estate. Why would you invest only in one country in real estate? If you really want to have a real estate portfolio allocation, you should have a global real estate allocation, which makes sense, right? And think about it, if you invest in bonds or in stocks where markets are accessible, you would never see an institutional investor investing only in German stocks. They always have a global approach. They have US stocks, they might have German stocks, they might have UK stocks, they might have some Asian stocks. So it's like natural thing to be globally diversified. But when it comes to venture, people think they have to only invest in their own cities sometimes even. You're living in Hannover, you think startups in Hannover are the best startups in the world. It's just stupid, in my opinion. Like, it could be, but the probability for that is very low. So that's why we think diversification in a market like venture is extremely important, and timing or picking is risky.
Right, absolutely. Great perspective on that. And now I'm going to ask my last main question before we go for the close. And this one is about, what's your one piece of advice for emerging managers or GPs looking to raise their first fund?
Yeah, good question. I think so. We live in a time of noise. So for VCs, there's a lot of noise in terms of companies, right? Because a lot of companies exist today, and a lot of companies pitch VCs. So it's considered a lot of noise. For us, it's a similar development in the last years. There's a lot of noise in the markets. So a lot of new managers who we would consider as average managers. And for us, it's getting more difficult to identify and differentiate venture managers. So what I advise is not to use, it's very important, not to use the common templates and common practice that a lot of advisors currently advise VC funds to do. So for us, if you do like everyone else, it's very difficult to differentiate. And today we have the feeling, every deck looks like it comes from the same design agency. Every thesis looks like, oh, that's the mega trend this year. So everyone jumps on that mega trend. Last year it was crypto. This year you don't see anything about crypto anymore, right? So the trend has changed, and all the VCs have changed. So for us, a VC fund today is still convinced that crypto, if they are specialists in crypto, is the right thing to do for them, is a good way to differentiate. So show us how you differentiate, show us how you are better than the rest in your market. That again can be a geography or a vertical. Show us that you have some kind of success within that. So either as a founder or as an angel, or maybe you've worked for a VC. So it's different ways, or you have built a different profile. Everyone knows Harry Stebbings, right? You're a podcaster yourself. So Harry was not really a venture capitalist before. So he was a podcaster, and he became a venture capitalist because he built that great profile for himself, right? And one of the best networks in the world, probably in the venture capital ecosystem. That's very unique. You can't copy that. You have to find your own way, how you build your profile and how you can access. And then one other advice that I would like to do is, think really through if venture is really the right thing you want to do. I think venture became in the last few years a very, very sought after job, right? That many people think is a great thing, but many people underestimate the commitment that you have to give into a venture capital fund. So a venture capital fund on average runs for 15 years. So if you start a fund today and you are 30 years old, it means that you commit the next 15 years to do one fund. Do you really want to do that? Are you able to raise follow-on funds? So otherwise it doesn't make sense to commit 15 years of your time. So you're building a business which is extremely long-term, and you don't know the outcome. So you don't know even if you are in the carry in 15 or 20 years. So you might be not successful and not wealthy at the end. And again, for 75% of the funds, this is the case, right? So only 25%, the top quartile will return better than, will return, let's say, good enough to have a reasonable carry for you. So having considered all this, think about, is that really the right decision? Do you really want to spend the rest of your life, or a majority of the rest of your working life, doing this VC job? This is a very important thing to think about before starting a VC business, I think. And I have the feeling that a lot of new VCs never think about that. And this can create, for them as well as for their LPs, great disappointments if they decide in 5 years, for example, to stop running the fund anymore. So it creates stress, and it creates conflicts within that business, and so you should avoid that and think really carefully if you want to spend the rest of your time, especially those who have never been investors, right? If you've never invested into companies, I still think that being a venture capitalist means you want to be a venture, like an investor, right? So finding the right case company, investing money in it, and making a great investment case out of it. If you're not really an investor, but you're maybe a great writer, or you are a great technical person and build products, maybe you should not be an investor. You should not be a VC, but you should be a founder or a journalist or a podcaster, right? So I think there are different ways to become very successful in today's times, and venture is not the peak, in my opinion, right? And especially if you're a young person, I would even say that if you have the skill set and the wish to be an entrepreneur, it's probably easier to raise capital as an entrepreneur compared to raise a VC fund. Plus, if it does not work out for you, you can stop in 2 years and say, you write off the company. It's a valid way to stop a business and start again or focus on something else. Whereas a VC fund, you are in something like a trap for the next 1-2 decades.
Right, absolutely. That was really really insightful for anyone planning to get into VC. And VC is actually a very shiny industry from the outside. It looks like everyone wants to get in, right? But yeah, that's some important piece of advice that everyone needs to hear. Thank you so much for coming on, Ertan. What would be the best place for our listeners to follow you, or maybe if they have a fund and want to pitch you, if you want to make that public, then what would be the best way to do that?
Yes. So following, I'm relatively active on, excuse me, on Twitter and LinkedIn. So that's the both channels that we use as a firm. And for me personally, same for my partner, Michael Jackson, is relatively, as you know, probably relatively active on LinkedIn. So that's the channels that we use mainly, um, where you can follow us. And for pitching your funds, the best way is to go over through our website. We have a contact us button, and again, you will land on an Airtable where you can just give us the information that we need. It's a few fields, like fund size, focus, etc., and you can also upload a deck, and that's the way how you make sure that the team has access. It doesn't matter, to send me an email if I get like hundreds of emails. It's sometimes I can't forward it, or I'm not, I'm missing some of the emails. So it's better to share it with a team, and the best way to share it with our team is to share it through our website. That's the best advice that I can give.
Great. Thank you so much. And I'll put all those links in the show notes below and the blog post I'll go along with this episode. Thank you so much for making time for this, Ertan. It was great talking to you. I loved all the insights that you shared. And
Thank you so much
happy
for
investing.
for the invite and for the questions. It was good to be here.
Thank you. Pleasure hosting you.